a lot of clients will default to asking tax questions. And a lot of CPAs, even ourselves, like we can defer all day long and still sound brilliant, right? Like if you ask me a tax question about syndications, Brandon, what are some tax strategies you actually use as a syndicate, or as a GP in a syndication? I'd be like, well, Gino, it really depends on your facts and circumstances, right? I mean, there's a lot of different angles that we can go. And now all of a sudden you're like, oh, facts and circumstances, that sounds smart.
Hello, everybody. This is Jake Stenziano, host of Wheelbarrow Profits Podcast, the #1 multifamily podcast on iTunes, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Good, Jake. I am not doing as good as you. You've got a nice little haircut going on today. The guy came over the house, did a little
so milky,
action.
so silky, so smooth. And
I just wish I wish I could smell it. I know you're looking good, bro. You said you're smelling good too. You're looking good today, my friend.
Just making it happen today. So, that's how we're doing it. Gino, what's going on with you?
Not much. Nice beach weather. It's the month of July. We got there a little fishing today. It's been a great month. We're doing a lot, Jake. A lot of stuff happening. The live event is coming up the next couple months. We're gearing up for that. We're onboarding tons of students. Our students are up to over 3,500 units closed right now. It's been a really great journey with Jake and Gino.
Wow, kicking down doors. So Today's guest is Brandon Hall. Brandon is a CPA who believes that real estate investing is critical to building sustainable and generational wealth. He'll also be sponsoring and attending this year's Multifamily Mastery Live in October. Gino, that's exciting, is it not?
It sure is, bro.
So, Brandon, without further ado, welcome to the show.
Yeah, thanks for having me on, guys. I appreciate it. It's good to be back.
Hey, welcome back. And let's get into this. In your opinion, Brandon, why is real estate investing an instrumental component to any investor's portfolio?
It's just the best way that I'm aware of to build wealth sustainably over a long period of time. You can put money into real estate. You can have other people pay down your debt. You don't have to pay tax on the cash flow that you're receiving. If you can replicate that many times over, like many of our clients have done, it just becomes a machine, a cash flow machine, a low tax income stream, and just a really great way to, again, build wealth over a long period of time. It's much better, much more effective than like a W-2 job or a business. I mean, the only alternative that I would say is building a business that scales in valuation very quickly or relatively quickly, liquidating it, but you've still got some pretty hefty taxes that you would have to pay whenever you liquidate, and then rolling those net funds into real estate.
So is that one of the reasons why you see real estate, especially multifamily, at these high valuations right now and continuing to rise?
I think that is just hot across the board. I definitely think that there's some sort of an underlying, fun factor to it, if that makes sense.
Mm-hmm.
Yeah, I mean, we see across the board, cap rates are lower across the board. We have clients all over the place, and deals are harder to come by. But deals are still pretty active in the multifamily space. We're still seeing some pretty good deals pop up, get acquired in the multifamily space, some successful syndications being run.
We love that. So what are some of the biggest mistakes you see when you're onboarding new clients, when they're actually coming on as new clients?
Oh gosh, we could be here all day talking about that.
That's why
they're still making money, but they're screwing up.
In the multifamily space,
yes,
it's honestly just not getting a CPA on board fast enough, and not getting a CPA that knows the space very well. And I know that sounds like relatively self-serving, but it's very interesting. There's a lot of attorneys out there that say that they specialize in the syndication space and the multifamily space. Then you review their operating agreements and you realize they've really just caused tax events, or they've created tax events for the general partners that have all signed these operating agreements, or the limited partners, through signing the operating agreement, have just granted the general partners a capital interest in their contributions, which I don't think that any limited partner would want to do. So it's really just having a CPA involved in that process early on. I can't tell you how many operating agreements just this year alone we've had to go back to attorneys and correct. And these, again, are attorneys that have been on podcasts specializing in syndication, in the syndication space. They're just not looping into CPAs early enough. So that's the biggest one that we see on the syndication side, and on the multifamily side, it's just not running a cost seg study. We've worked with several folks this year where, they put the property into service late 2017 and they missed out on 100% bonus depreciation because they didn't run a cost seg study. So we're retroactively running it, retroactively claiming the bonus depreciation. But of course, now it's a lot more expensive because we have to do something called a 481A adjustment, which is costly for the client. So just not understanding the tax plan going in, not looping the CPA in early enough. Those are key mistakes that we often see in the multifamily space.
So what would you say to a person starting in multifamily as far as acquiring team members? Because everyone's always focused on the broker relationships. Let's find those deals. Maybe even an inspector, maybe even an attorney. I think the accountant is like, yeah, I've got my uncle who's doing taxes and he can take care of real estate. What would you say to that investor?
Yeah, I would say don't use your uncle. Unless your uncle can scream from the rooftops confidently that he works with syndications, works with multifamily real estate all the time. Don't use your uncle.
You've heard that, Brandon. You've heard that because I've heard that from a lot of my students saying, you know what, I've got a family member, my cousin's doing my taxes. I'm like, oh.
Yeah. Actually, what we see most often is we'll have the son or daughter come to us and they're the ones that are syndicating. And they're like, well, I was planning on using my dad's account. They're going to give me a $500 tax return. I'm like, you can do that. It's going to cost you a significant amount of money in the long run. You do whatever you want though. Dad's accountant was great for the manufacturing space because that's the business dad has, not great for real estate. And real estate is just such a niche piece that you really do have to understand it inside and out to get the good tax advice.
Just a quick statement here for everybody out there. And I've been speaking to accountants lately. I've been speaking to attorneys. Let's just do this. Let's all agree that even if we're starting out in real estate, we're getting into the game. We're not going online onto Google and downloading a purchase and sale agreement. Okay. We're going to go on. we're going to pay a few $1,000. We're going to work with an attorney and get it right so it holds up. And we're going to look for somebody that understands real estate accounting to make sure we're maximizing, because the reason we're in real estate is because of the tax advantages. It's literally half the battle. Yes, we're going to get cash flow. Yes, we're going to build wealth over time, but it's combining that with the accounting side of it that makes it so lucrative. So I'm just pleading with everyone out there, please set it up correctly on the front end, save yourself a headache, get somebody on the front end, good attorney on board, get yourself with a good accountant, put them together. You go find the deals and make the management piece of it work, and then let the folks that are working, in those professional services do their thing.
Especially if you're taking on investor money, right? I mean, yes. It's just a completely different ball game, and you can't be messing around with dad or Uncle Bob's accountant. You gotta go out there and find somebody that's in the space every single day, that works with all the syndicator people that that's the person that you need to be attaching yourself to. Or at least be, to just get reviews from or tax advice from or anything like that. It's funny. Every once in a while, we'll have people that come in on the sales side, and I'll talk to them and I'll give them our pricing. And our pricing is 2, 3, 4, 5 times more expensive than what you're going to see elsewhere with other CPAs. And they'll come back every once in a while and say, well, I've got this other CPA that is only a third of what you guys cost. And I'll be like, okay, well, why are you having this conversation with me then? Why don't you just go with them? And well, I'm going to be the first syndication client that they work with. And I'm like, so by not paying an extra, maybe $2,000 for us, you're going to take that risk that they're going to screw things up for you and your investors. That's, if you want to take that risk, go for it. But most people, once you have that conversation with, they're like, yeah, it actually doesn't make sense to go that route. It's just, again, it's such a niche piece of the code. It's not a big piece of the code, but it's a very niche piece of the code. You have to understand every single tax court case. You have to understand every piece of all the regulations, all the memorandums, and you got to understand it inside and out. You got to see it every single day to really get a good grasp on it, because it's a very complex piece of the code. So,
Brandon, if you had to pull out 1 or 2 things of the difference between doing a deal like Jake and I did ourselves, partnering, and syndication, what is 1 or 2 really big high level things that are completely different when you're doing those different returns?
The biggest, well, with the tax returns, it's just a little bit easier when it's a smaller group, because there's not all these K1s that you have to build out and send out. You don't have to look at UBIT, UDFI regulations. You just kind of send out the K1s to the partners, because they're generally just investing themselves. Mm-hmm. a little bit easier from that perspective. You don't have to manage the investors. You don't have to report to investors. Like a lot of our clients that are just partnering together, they'll buy these big apartment buildings, but they won't have any sort of professional accounting system in place. And, while it might pain me to say this, they don't really need it in place. They can reconcile everything on a spreadsheet at the end of the year, or they can look at their property management statements on an ongoing basis and get a good grasp for how their business is performing. But when you add investors, you have a fiduciary duty to maintain or to do well for those investors, to act in the best interest of those investors. And that means that you do need the professional accounting systems in place. You do have to up your game a little bit, hire the CPA or the attorneys or whoever. You can't go online and get a buy sale agreement. You can't go online and get an operating agreement. You really have to spend the time and the money to get this stuff right. Because otherwise you're going to have, 20, 30, 50 different people that are going to be coming after you at some later point when they realize that you were relatively negligent in your operations and structuring that team.
I've got so many questions, Jake. My head's exploding right now. But one that really I want to touch on is I want you to give us a story of a nightmare scenario of somebody who did not come to you and they did their operating agreement wrong, or they set something up and they came to you and you're like, a few $1,000, I could have saved you a lot of time. Do you have any of those stories for me?
Quite a few, yes. Definitely in the syndication space, more so in the syndication space than not. Typically when we get into like the individuals like that are buying property either to flip or buying property to hold, even if it's small or large property, typically it's the entity structuring piece that really shoots them in the foot. We always tell people, if you're investing in rental real estate, entity structuring is not typically not going to help you save money on taxes, but it can certainly hurt you. So we've seen clients like buy a property, put it to an S corporation, they're rehabbing it, they're doing this big value add, and they decide instead of liquidating at the end, we're just going to hold it, and they distribute it from the S corporation, and now it's a taxable event. They didn't realize it. We had one client go to their attorney instead of coming to us, and the attorney just closed the S corporation, but they had like a $300K net profit on their, or $300K value add essentially. And when you close the S corporation, it's a taxable distribution. Now we were able to work with them to avoid a lot of that, but still it was like just up front. If you would have just literally spent $250 for an hour phone call with us, you would not be facing a $60,000 tax bill. Mm-hmm. So like little things like that on the individual side, just not making big moves until you loop in a CPA. But on the multifamily side, it's really upfront, that operating agreement, the entity structuring, and just getting the tax strategy in place. I mean, we've had syndications come to us or general partners come to us. They've been in default of their loan for months and nobody's told them. One of the things that we do whenever we're doing due diligence on a client. So we do due diligence on the client because we don't want to inherit a ton of crazy issues unless we know how to solve them and can tell the client up front, we have to solve these issues for you. One of the things we do is we review the lending documents and we ask, hey, what reports have you been sending your lender on an ongoing basis? I would say 30% of the time, they're never sending the correct reports. They're sending the report that the banker emailed them to send, which is fine generally. The lender's not going to come after you for it. But if the lender decided to come after you for it, they would say, well, you're supposed to send us 15 reports on a monthly basis. You're only sending us 2. So we look at that. And, the next line item on that reporting section in the mortgage documents always says, by the way, if you don't send us these, you're in default of the note. So we will help people kind of coordinate with the bank there. But then it's just on the operating agreement. We helped somebody recently. They had an operating agreement structured by an attorney, didn't get it signed off on by a CPA. It created a taxable event for them the day that everybody signed that operating agreement. Basically what they did is the LPs invested like $1 million. The way that the distributions were structured, there was no like in the event of a capital liquidation or anything like that. So it was just this one little distribution section. And basically it just said, first, we distribute to the investors at an 8% pref. Second, we distribute 30% to the GP, 70% to the investors, the LP, until all capital is returned. Well, the problem is that what that does is it effectively shifts $300,000 to the GP at the signing of the agreement. Because what you do is you walk through this scenario of, if I were to liquidate this property or this entity, if I can't sell the asset at all, well, that's a different scenario, but if I liquidate everything today at face value, I close everything down. We look at the distribution section and we say, how are the funds distributed? And in this case, if you closed everything today, the day after signing the operating agreement, the general partners were going to get $300K of the LP's funds, 30% of their funds. And what that does is it creates a capital shift, taxable to the GP. And of course the LPs, like I would never invest in a deal if I'm an LP and they can close it tomorrow and take 30% of my capital contribution. So it's just like little things like that can really set you up for failure if you're not careful up front.
Wow.
I got a personal one if you guys want to hear it.
Yeah,
going back to the old school. This was and this was not a syndication, and this was I'm a mentality. Gino and I bootstrap and everything. So didn't want to pay the attorney fees for eviction, and I used to wear a suit every day to work, believe it or not, when I was in the pharma and vaccine world. So we had people that we had to evict. So I'd show up to court. I'd answer the questions that they said. Did they not pay? No, they did not. Blah blah blah. And then on the third or fourth time, I think it was the fourth time because I was 3 for 3, nailing my evictions with no formal training. The judge looks at me and goes, "Son, are you an attorney?" And I said, "No, I don't think so." And he said, "But this is a limited liability company. You can't be representing yourself." And I said, "Oh, sir, I'm so sorry. I didn't know that." But he let me through, and he let me process that eviction. So I think I went 4 for 4, and then I retired. So I was an attorney for a little bit, and I just want you guys to know, don't cheap out in the beginning because you might get your risks. This could have extended the eviction. Who knows how long? It's like $350 to pay the guys. So, that's one thing where you just avoid. But it was a fun run while it lasted. So yeah.
I'm glad you're done with that, right?
Glad I'm done doing that. Yeah. So
now he's wearing MIH shirts instead of wearing suit and ties.
It looks like him, in the reverse, but it's really an MIH shirt.
So Brandon, when I'm looking for a CPA or somebody who's qualified, what are the qualities that I should be looking for in a Brandon Hall?
Yeah, that's a good question. I wrote an article on this on Bigger Pockets a few years ago when I was just starting out. I don't even know what made me write the article, and I reread it recently because I was talking to a prospect who was looking at it. And he joked. He was like, "Do you have a P10?" And I was like, "Of course I have a P10." So I pulled up. P10's a prepared tax identification
I
number.
said P-TAC. I think he was talking HVAC. No.
Yeah, pretty close. But I took a look at this article and I was like, man, all this stuff that I wrote doesn't even make sense. I mean, there's so many articles out there about how do you find a CPA, and you should definitely do your due diligence, make sure that they're in good standing with their licensure and all that stuff. But really what it comes down to is you shouldn't be picking a CPA who does not, like, loud and proud exclaim on their website that they do real estate. If you go to their website and you see that they're in 10 different industries and they have a small team of people, then they probably don't specialize in any one of those industries. If you go to our website, you see all we do is real estate. That's the only thing that we do. We have all these articles on it, podcasts on it, YouTube videos on it. We have blogs on it. I think I just said that. And then we have case studies and everything. So if you're going to go to, in order to figure out, I think, if a CPA is an actual real estate CPA, first, what does their website say? Are they proclaiming it to the world that that's what they do, that's what they specialize in? But two, I think that there is a lot of value in going to your local groups, going to the online platforms and asking who other investors are using. If other investors that are where you want to be are using a certain team, then give them a call. Call them up, figure out if they're going to be a good fit for you. That investor trusts them and so you can kind of rely on that to some degree. And we have seen some of the larger investors, even some investors that are relatively well known, use bad CPAs. So I'm sure that they've been referring out, and that's fine. But at least you're not kind of like going in blind and just picking up the phone and calling some random CPA that nobody's using, or some local CPA that doesn't specialize in real estate. At least you'll be off on the right foot.
So what kind of questions? Give me a couple of questions that I need to ask you to verify you, to see if you know what you're talking about.
Yeah, that's tough too.
Background check?
Yeah, background check, credit check, run through the ringer. No, that's tough too. And I think that it's tough because a lot of clients will default to asking tax questions, and a lot of CPAs, even ourselves, like we can defer all day long and still sound brilliant, right? Like if you ask me a tax question about syndications, Brandon, what are some tax strategies you actually use as a syndicate, or as a GP in a syndication? I'd be like, well, Gino, it really depends on your facts and circumstances, right? I mean, there's a lot of different angles that we can go. And now all of a sudden you're like, oh, facts and circumstances, that sounds smart. This guy knows what he's talking about. And really, I could be like, I have no idea what I'm talking about, but I'm just going to say all these cool things that make you think that I know what I'm talking about. So I would ask more like questions around how many other syndications have you worked with in the past? Can you give me examples, stories of how you've helped syndications in the past? So have them explain their services through stories. I've found that to be relatively effective. When prospects ask me, for example, kind of like the question that you asked, I'll have people every once in a while ask me, hey, Brandon, I'm running this, I'm thinking about starting this syndication up, yada, yada, yada. Can you tell me about a story, how you helped somebody in my situation? And either I have to be really good making it up on the spot, or I have legitimate stories that I can share with you. And you can kind of gauge from that how well versed I am in the space. Am I using your same language? Like all prospects all the time will tell me it's so refreshing to talk to somebody that understands what I'm talking about. And I don't even think that I'm talking about anything incredible. I'm just like referencing cap rates and talking about how a GP and an LP split and accredited investors. And that's just those are just some things that other CPAs, I think, leave off the table, at least per the folks that I'm talking to.
Mm-hmm. And let me ask you.
One thing that, Gino, one quick thing I think it's a good tip for everybody. It's also a top grading thing is that I think you want to see 3 references from current customers. So I think if, Brandon can provide 3 customers and they may be, well-known folks in the space, they can talk about their experience, regardless of who you're going to use. Put a big emphasis on that. And I think it's a great way when selecting vendors and partners, because they're going to be able to tell you, hey, love working with these guys. This is where they shine. This is where I think they can improve. And then you can make an educated decision based on that feedback if you can get good references.
I like that. So Brandon, what have you seen in the difference in the last 3 to 5 years in accounting and CPA and in the space that's really changed things up a lot?
Well, there's been a lot of tax changes, and we've seen not a whole bunch of CPAs kind of understanding those tax changes. Going back to 2013, there was the implementation of the tangible property regulations, and there's very few CPAs that understand the tangible property regulations inside and out, and that affects every single real estate investor, large or small. And it's just so niche, so unique. The idea was to consolidate a bunch of rules into one big push, and it just, a lot of CPAs just didn't follow it. We get CPAs that are still using like old CapEx policies that don't make any sense under the new regulations. Then you've got the 2018 Tax Cuts and Jobs Act that changed a lot of things up again. And you still have a lot of folks that aren't really understanding that inside and out. So in terms of the tax space, it's definitely become more advantageous to be a real estate investor, I would say, over the past 5-7 years or so. In terms of the accounting space, I don't know that much has changed in the accounting space. I think it's gotten a little bit more technical in terms of how you book things. If you have investors again, you need to be a little more serious about it, especially when we're talking about the tangible property regs that came out back in 2013. Again, those regs that came out in 2013. So you need to be a little more detailed in your accounting records, but nothing significant there.
Have you seen, in technology-wise, as far as technology goes, have you seen it impact the CPA space or even the real estate space? What have you seen from that angle?
Yeah, that's always interesting too. We are big users of technology. We try to find the best platform to use for the one specific purpose that it solves. Then we try to connect it to everything else. So I'll say that the connectors have gotten a lot better, like Zapier or If This Then That. I've tried to encourage a lot of our clients to get off of spreadsheets and use Google Sheets instead. We work with a really big client, a big real estate fund, and they run pretty much their entire business on Google Sheets. But they've created Slack bots, they've created automations via Zapier and If This Then That allow them to automate a lot of their Google Sheets. They couldn't do the same business on spreadsheets. So we've seen a lot more automation, a big step up in automation, but a really big step up in the amounts of technology that are coming out to solve specific pieces of business, specific issues, and then connectors coming out to connect those to whatever your core technology stack is at the time. We've seen that both on the real estate side and on the CPA side. It's a lot worse in the CPA space. Mm-hmm. So we're kind of like paving new frontiers just by trying to connect everything together. Most CPAs will use like Thomson Reuters or CCH and use their whole suite of services, but they're great at the tax. They're great at tax research. What we found not so, a little bit more cumbersome on the practice management side.
And what would you tell investors when they start onboarding and they start buying properties like Jake and I, we started with QuickBooks. And from QuickBooks, we quickly outgrew that. We went to RentPost. I don't know if RentPost was a terrible platform. And it wasn't terrible. We just got too big. And we took too long to actually get into AppFolio. And once we got into AppFolio, it was awesome. But even the mom and pop, when they first start out, I think AppFolio is too big. Do you have any other solutions? Or I think Google Sheets would be great. But I mean, any other solutions out there that they can look at?
Yeah, I mean, people use Buildium, AppFolio. They combine that with QuickBooks Online or Xero, XERO. QuickBooks Online and Xero are going to be your accounting platforms. So you get the professional reports, you get the automation, the rules, the bank reconciliations. I guess it really just depends on what you need. Like I was talking to one of my other employees, Taylor Brugna. He's a CPA here at my firm. He has 60 properties. And I was talking to him because I was like, I don't really know, aside from just giving people financial reports, like I don't really know what we're doing for our accounting clients, like what real value we're adding. And I mean, the financial reports are valuable, but I'm thinking in terms of like a business owner, I've got KPIs I want to track. I've got cash flow that I want to track and be able to allocate to next month. And we're really doing a lot of that. And he was basically like, yeah, well, we can't really do that in QuickBooks. And then I found out that he doesn't use QuickBooks with his 60 properties. He uses a spreadsheet that I built out back in the day to make it easier for our clients to consolidate their tax reporting for us for each one of their properties. And then he just built a dashboard on top of that. And he does that for 60 properties. He uses Google Sheets for 60 properties and manages perfectly well with 60 properties. And so we started talking through it. We're like, there's not really a good platform out there that is basically like Google Sheets, maybe a little bit amped up, that people can trust, that you can kind of get some automation with. And so we're actually building that out now. So it's going to be like some web-based interfacing tool. We're about I think 70% of the way through the development. There's Stessa. Stessa is a good option for the individual landlord. I think that it gets a little bit, from what I've heard, I've not personally used Stessa, so that's a disclaimer, but I've heard that it gets a little bit challenging when you get into the multifamily space and you're really focused on the property management piece of it. But I don't think that a lot of landlords need to use QuickBooks Online or need to use Xero. I think that you can get a lot done with AppFolio or with Buildium or simply with spreadsheets and building out Google Sheets specifically, not Excel, but Google Sheets, and then building out automations or workflows in and out of those sheets.
What do you tell your clients as far as creating entities, LLCs, S corps? What do you traditionally look for?
So it depends on the type of income that you're earning. There's two key types of income that we see our clients earn. It's ordinary income and passive income. Ordinary income, if you're materially participating in a self-employment activity, it's going to be subject to FICA tax. Self-employment tax, Social Security tax plus Medicare tax. That's what makes up self-employment or FICA tax. Mm-hmm. As a W-2 employee, you pay half of the 15.3%. So you pay 7.65%. Your employer pays the other 7.65%. But when you're self-employed, when you're generating ordinary income like flipping, developing, constructing, contracting, providing CPA services, you pay both halves of that self-employment tax on your earnings. You pay 15.3% total on those earnings, and then you pay your marginal tax rate and your state tax rate. So your total effective tax could get to 45, 50%. If you're out in California, even higher, if you're not careful, if you don't have the entity structured appropriately. So the first thing that we'll do with them is first thing that we do with any client was just ask, what type of income are you generating? Ordinary income or passive income? If you're generating ordinary income, we need to look at LLC S Corp statuses. We need to look at potentially roping in C corporations to siphon off profits from your business, depending on how big the business is. And the S corporations really help us avoid that FICA tax if we can structure it appropriately. And it involves this whole thing about determining a reasonable salary. We do a lot of research there. We don't just come up with a random percentage. A lot of CPAs will just say, oh, if you net $100,000, pay yourself $40K in salary, 40%. Therefore, that's a good range. And that works right up until you get examined by an auditor and they ask, how'd you come up with 40%? And there's no answer. So we try to substantiate that through legit research. That's step one. If you're on the multifamily, or if you're on the real estate side, multifamily, single family, condos, whatever, generating passive income, then it's generally more of an LLC trust sort of structure. And what we'll do in that case is we'll say, well, we like to quarterback the relationships. We like to take what you're saying, take what you're telling us, look across our client base, see what other people are doing, give you those insights, and then tell you go take those to an attorney to get them implemented. Because if you're on the real estate side, the passive income side, what's more important is the liability protection than the tax protection. Like I said, when you're generating passive income, the entity structuring is not really going to help you save money in tax, but it can certainly hurt you.
Mm-hmm. Like that. Before we get to the short answers, I just want to get your best, I guess, CPA advice or tip for the listeners.
Always look at cost seg studies. You can pair cost seg studies with 100% bonus depreciation and get a really big write-off in the year that you acquire properties. Some of our clients that do this successfully don't pay tax year in, year out, because they keep buying properties, they keep doing cost seg studies, and the big passive losses offset all of their other passive income or offset their ordinary income if them or their spouse qualifies as a real estate professional as well. And that'll be the other factor to that too. So I was recently working with somebody who went to all these mastermind groups, and they were like, you got to do a cost seg study. It's a no-brainer. Well, he has a full-time job. So it actually doesn't make sense for him to do a cost seg study because, well, that case there was a lot of other factors there, but he couldn't take the passive loss because he didn't qualify as a real estate professional. So then it's like, well, how effective is that cost seg study at the end of the day? But the cost seg study, understanding what a cost seg study does, understanding what that 100% bonus depreciation, how much that can actually yield for you. I think once you understand that, you'll understand the power of cost seg studies. You'll understand the power of acquiring real estate and investing in real estate. And you'll understand the power of just investing in other syndications, because these syndications, they're doing the cost seg studies too. So if you're an LP investor, if I invest $100,000 into a syndication, and they do a cost seg study, I could probably count on $90,000 to $95,000 in passive losses flowing back through to me in the first year.
What you probably understand is that you got to become a real estate professional and put a cherry on top.
Yeah, so you do have to be a real estate professional. There's a lot of working pieces there, but if you start at that cost seg study and understand that, then you just understand that the passive loss that it generates is big, and then figure out, well, can I take it? How do I take it? What does that look like? And then for the multifamily guys, understanding the tangible property regulations. I was about to say the TPRs, but nobody would know what that is. So understanding the tangible property regulations is key. And that's going to dictate your value add strategy whenever you're buying multifamily property. If you're not having a conversation with your CPA about your rehab strategy, then you don't understand the tangible property regulations. And neither does your CPA, because they're not bringing it up to you. Mm-hmm. So have a conversation with your CPA about your value add strategy if you are value adding multifamily property, because it's critical. It's very critical with the tangible property regulations. It depends on whether or not we're deducting costs or we're capitalizing costs.
If you're interested in building wealth, you or your spouse should become a real estate professional. I think that's fair to say.
Yeah. I mean, you can definitely avoid tax if you or your spouse are a real estate professional, for sure.
Yeah. All right, gang, let's take a quick time out to hear from our sponsor. Gino, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. I know that you've been hard at work helping Jake and Gino students do just that using our framework. Can you explain to the listeners how they can get our help?
Guys, we've been hard at work growing our community of like-minded investors, and the results of our members has been nothing short of incredible. We're looking to grow this amazing group. What we're looking for is those who want to follow our proprietary framework that we've created: buy right, manage right, and finance right. Leverage our connections, education, and mentorship as ways to take your business to the next level.
So if you're interested in finding out more about how you can become a part of our amazing community, apply to work with us at jakeandgino.com/apply. All right, and we are back. You were talking a minute ago about some property management software. What companies do you like working with, and why?
I mean, I like Buildium. I think that they're a great team over there. I think that their software is good. I think that's affordable, especially compared to Appfolio. But I like their software from a property management perspective. I think that it's good. I think from an accounting perspective, it needs some work. Same thing with Appfolio, though. There's not something on market that at least we have found where we have just thrown our weight behind and said, yeah, this is perfect from an accounting perspective.
How much have you done with one site?
Not much.
You want to talk about spending some bucks? They're quite expensive as well. But
yeah.
What about a tip for scaling up?
In what sense?
So you got guys that are starting out, and we were talking before about their, getting into it, and they're not necessarily partnering with folks correctly. They go in, they maybe buy 40 or 50 units. What do you see from, the outside looking in where guys are making mistakes and then they could be scaling better early on and accelerating the process for themselves?
Yeah. I would say that it's understanding what you're good at and what you're not good at, and just being honest with yourself and understanding that what you're not good at, you need to outsource, and it's going to come at a cost. Or you don't need to outsource and you just need to spend a lot of time doing it. So we have a really successful syndicator that we work with, and from the very beginning, they outsourced everything that they were not good at, and they're scaling very rapidly. We also have a lot of syndicators that look at the costs and they're like, I don't really want to, and not even necessarily like CPA costs, just other sorts of costs like contracting, property management. People want to manage their own properties. It's bizarre, but they'll do these things that they're not good at, and it just holds them back, because what happens is it makes them think about these tasks that they're not good at solving, and it makes them waste their brain power on those tasks versus, if I'm really good at acquisitions, then I'm going to structure a business that all I ever do is acquisitions. And I'm going to make sure that, yes, I'm going to have to manage the property and all that stuff, make sure everything's performing. But at the end of the day, I'm going to set a list of KPIs that my property manager has to meet. If they don't meet it, I'm switching property managers. No ifs, ands, or buts about it. They're a contractor for me. Same thing with my CPA. I'm going to set some KPIs. Okay, CPA, I need my stuff done by March 1st. Can you do that? Great. If you can't, I'm switching CPAs. Attorneys, same thing. You can set these KPIs with everything that you're not good at. And you can manage your business effectively that way, and then focus on what you are good at to continue scaling. Or if you're really good at the operations, like find somebody that's good at the acquisitions. Or if you're really good at the acquisitions, partner up with somebody that's really good at the operations. There's no reason that you have to go into business by yourself either.
All right, so this is a perfect piggyback to that answer. What traits do you see in the firms that you're working with that are the most profitable, and what KPIs are they using?
So firms as in syndications, like capital?
Correct.
Yeah. So the folks that we see in the syndication space that are most successful have a set list of KPIs that they are primarily holding their operations accountable to. They'll typically have one person responsible for operations, one person responsible for acquisitions, or multiple people responsible for those different areas, but at least one person responsible for each. Typically, the same person is not responsible for both. So you've got one person who's great at the acquisition piece. Have you ever read the book Traction?
Mm-hmm. Oh, yeah.
So I've read the book Traction. I've tried to figure out how this applies to the syndication space. I think that the people at the acquisition level that are really good at that are the visionaries. The people that are doing the operations are the integrators. They're really good at the day-to-day. They're really good at holding the property management companies accountable. Our most successful clients have one of those each persons. That was bad grammar. And typically on the operations side, the KPIs, they don't have to be anything sexy. It's just, it's as simple as what's our loss to lease and how is that trending? What is our debt to value ratio or loan to value ratio? How are we doing in terms of new lease ups? How many units? What's the lag time if we're doing any sort of value add? What's the lag time per unit on getting it on market, right? So planning for the future, understanding when those units are going to come online so you can start leasing them out. The KPIs are different per company, but typically it's always we always see like some sort of loss to lease. We always see some sort of economic vacancy, physical vacancy, and they're saying, okay, well, at this quarter mark, we need to be here. At this quarter mark, we need to be here. And then you can work backwards from that to say what activities need to happen in order to get that rolling. And I mean, people are always like, well, doesn't the property management company kind of drive a lot of that? It's like, well, no, at the end of the day, they don't, because you're responsible for it all at the end of the day. You're responsible for this property performing. Yes, you're trying to find the best team members, and you need to be able to tell the property management company what you want to hold them to and if they can perform on it. It's really as simple as that. It's no different than if you had employees. If I have employees, I'm not going to let them just do whatever they want all day long. I'm going to say, you are responsible for X, Y, and Z, and here's how you're going to report it to me. Can you do that? If you can't do that, I'm not going to hire you. And if you can do that, that's great. We're going to work well together, and we're going to make a lot of money. It's going to be awesome.
So Brandon's best tip for scaling is to have correct KPIs in place and treat the property management relationship like an employee. We got you, man.
There you go. Yeah.
So any tech, that you've seen recently, all these articles are coming about how tech is making its way into real estate. There's all these asset management platforms out there now. And you may have not, have experience with much of it, but have you seen anything on the rise that you're like, that's interesting, I like that, or you want to share any of that with the folks?
Yeah. I haven't seen any specific tech platforms, especially when it comes to like multifamily or dealing with investors, that I would say, oh, that's awesome. 100% use that. I think that it's great that all this tech's coming out. I think that what we'll see is some sort of saturation at some point, and you'll have a few leaders that just eat everything else up, or they're able to sustain their business model and keep going. I'm really curious to see who's around over the next 2 to 3 years. That's what I'm really curious to see. But again, I would say if you're not using Zapier, if you're not using if this then that, then you're missing out on a lot of automation. You don't have to go get the new shiny, very expensive technology that's out there to solve your needs if you know how to build workflows in Zapier and if this then that. It's really not that hard to learn. Again, our biggest client, they're this really big real estate fund. They run almost their entire business out of Google Sheets using if this and that Slack bots that they built. Smart guys, but granted, again, it's technology that you're just building workflows with, and they don't use anything sexy, I guess. So don't feel like you have to, but that was probably a bad answer to the question.
No, it's a
I'm a Google guy.
Dude, I'm pushing for Google Sheets everywhere, and that's all we're using. So like I'm with you on that, and but we use other stuff. We use AppFolio, we use CrowdStreet, we use some of this stuff, and literally was just didn't know. I'm trying to stay cool and hip and cutting edge, and I'm looking for guys like you to tell me there's something better than Google out there. And if there's not, man, I'll set with a Google. It's free, for the most part, and we'll go with that.
Well,
you can get something here.
Yeah,
I'll be honest with you real quick. Like at CrowdStreet, AppFolio, Buildium, Yardi, all that stuff. All that stuff's great. Xero, QuickBooks Online, it's all great. It all has its place. It really wasn't until we started working with this client though that we realized the power of Google Sheets and combining that with Zapier and just different APIs that you can connect with. Again, you don't have to be a professional coder. Like I've learned this in my spare time.
They're using property management software though, right?
Well, they have property managers at the ground level that have property management software, but they're not using it.
Right.
It's
wow.
just
they're using their business. They're just not the ones directly.
Right. Yeah.
So Brandon, I've got a question that I know Jake will probably just want to strangle me over, but two words, blockchain. Do you see blockchain? How is it going to affect or revolutionize the accounting space?
Yeah. So haven't seen it implemented. There are some firms that are building out, and I believe testing. Mm-hmm. There was a lot of excitement around it. And I think that there still is, but I think that a lot of CPAs have just kind of brushed it off in terms of, not going to be that big of a deal. I could see it being very effective from the audit perspective. Whenever you're auditing, you have very specific tasks, and it will definitely make auditing more efficient, potentially even eliminate the need for audits, which would be nice. Auditing, you're going through and ensuring that different processes, procedures were followed. Mm-hmm. And if you have blockchain, you don't have to go and ensure that because the next block is created by the execution of the previous block. So I think that it'll really help auditing. I'm not sure how to help tax. I'm not really sure how to help actual accounting quite yet. And I don't know that we'll know for another couple of years, but the CPA, the industry is definitely talking about it. Everybody's excited about it. I also think a little bit of that excitement has kind of weaned off a little bit.
Well, what's funny? The CPA tax scene is like the multifamily scene and like the self-storage scene. There's a lot of mom and pops out there who don't understand the business, right? So they're all fragmented. It's such a fragmented industry that when a new technology comes out, like being on the cloud, right? 5 years ago, being on the cloud for accounting software, that was like you have the mom and pop CPA. They're like, cloud, I ain't doing the cloud. Now, if they're not on the cloud, you're basically out of business. So as you see these new technologies come about, it's just going to change. And once blockchain and once crypto, you start doing your own crypto, I mean, it's game over for a lot of guys as far as raising capital.
I want the Jake Gino crypto just because.
Within the next 5 years, people are going to start doing their own crypto, and they're going to start actually minting their own crypto. And you're going to be raising money where you can invest in the Jake and Gino, buy crypto. It's going to be I'm talking now. I don't know what I'm talking about, but I know that's going to happen. And the big players out there are just going to capitalize on it. We're going to be here we're going to listen.
Can I keep it under the bed?
Dude, I don't even know about mining and stuff.
I want the coin to have the Wheelbarrow Profits logo on it. That'll be good.
How do you think blockchain is going to change the multifamily space or the syndication space?
How do I just from raising capital? I mean, just being transparent, just being totally open source, right? I mean, that's what it's going to do right now. Right now, crowdfunding is a pretty weird thing where you need to go on certain spaces, and it's all about, I guess, technology. Can you imagine when it's easy, when somebody can invest $5 in your multifamily project, right? They give $5 here and $5 with Jake and Gino, and $5 with another person, and $10 with another person. Make it such low barrier to entry, and the costs on it are so prohibitively low that anybody can do it. Think about that. That's pretty amazing. I don't know when it's going to happen, but
and then it depends how much presence you have, because if you have a large platform and you can get out there and everyone's throwing you $10,
dude, it's Insta. You're on Instagram with millions of followers, and you've got 30 million Twitter guys, and you're selling.
Instead of hitting the heart and giving you love, they're giving you $5 for your thing, right?
Can you imagine that? That is like that's
ching, ching, ching.
That's revolutionary, dude. So
I've seen Wreck-It Ralph, breaks the internet, right? When they keep giving the hearts. That's going to be Wheelbarrow Profits money coming in, right?
I think the big issue with blockchain is going to be adoption, and it's going to be adoption by the big agencies that govern a lot of this stuff, right? So like the SEC, it would be interesting how they adopt the use of blockchain. How does that affect the building of PPMs? Do you even need PPMs even more? How do you source all of that?
Just the way all these software companies do it. You read this 25-page disclaimer, you skip through it, and hit next.
Yeah, you scroll to the bottom so that you click the I accept. Otherwise, it doesn't let you click.
Hey,
it.
Man, there was the face technology. They read my face.
Right.
I agreed to it. Yeah. The threshold's only $100. Let's not worry ourselves here. All right. So I got a serious question here, and it could go off into like a death spiral, but I'm going to ask it anyways. All right. As an owner of multifamily properties, an investor, actually, I'm going to have Gino give. Gino, what is it? Income is vanity? What's the quote?
No, revenue is vanity.
Yes.
Profit margin is sanity, and cash is king.
So I'm going to tee it up with that, and I'm going to ask you this because it's something that I struggle with, and we're working on systems internally to help it out. How do you bridge the gap, especially for multifamily owners, from accounting to cash flow? Because I can go on, look at a nice accrual income statement, but I want that, in accounting's one side and money in my pocket at the end of the month is another. How do you help folks do that?
So you have to understand that accounting is a necessary evil when you're doing the syndications, right? You need it.
Or even a private investment. Gino and I go buy a property, same thing.
Even if you're not running a syndications, it's still a necessary evil. And it's a necessary evil because we can't fill a tax return out unless you have good books and records, right? It's useful from the sense of where you can see trends, right? So like right now in our business, we're looking back at the last 2 years, the accounting records for the last 2 years, and we're asking, is there a summer slump or is there not a summer slump? And how big of a summer slump is it? Is our process broken? Is our sales process broken? Do we need to enhance it? Like what's going on? So it can be good from deriving historical insights, especially related to seasonality. Maybe you find that lease-ups are easier in January. I don't know, which would probably never be the case. But maybe you find that lease-ups are easier in January because you have all this historical data. So accounting is good from telling the history. It's not good from I have cash and how do I spend that cash next month? And that's where that's the advising that we do. And that's the difference is accounting's great, but I still have cash in my bank account and I don't know where to apply that. I'll tell you, one of my big things was, it was like into 2017, I had outsourced my firm's accounting and these guys were doing great. They were giving me accounting reports and I would look at it and say, well, this is fine. But then I look at, net profits, 40K or whatever. But then I look at my bank account and I've got 150K. What does that mean? Like, where do I use my cash? I know that next month I've got 100K in payroll and like all this stuff. So will I have enough cash? As at the end of the day, like, will I have enough cash? That's the question. Accounting was never able to answer that for me. So what I started doing is I started budgeting, and I would budget out the next 3 months. And basically I would have at the top, here's how much cash you need to earn to make it through the next 3 months. Here's how much revenue you need to earn through the next to make it through the next 3 months on a break-even perspective. And then if you add in the profitability. So we help syndicators understand that. can you make next month's mortgage payment if you issue a distribution to your investors today? Or even if you're on the individual level, can you take a distribution? If you got $150K in cash, can you take a distribution right now? Where do we need to allocate that cash to? So you do have to kind of, the accounting tells you how you got to that cash point, but the cash, the $150K cash could be like 2 years of building up that cash, right? And that's what the accounting will tell you. But then you have to say, how do I actually use that cash?
So it's important. Jake and I had created something a couple of years ago. We create a baseline for everybody. So create a budget for yourself, and we create a baseline. And I do it for Jake and Gino, and we do it for the properties. What's your baseline that you need every month, whether it's a mortgage payment, property taxes, insurance, and that baseline cannot go below that. And if it does, you have to replenish it. And if it's above, whatever it's above, we tend to draw it. We draw the remainder of that. So that's how we started out, because it was like erratic every month. Like you said, it was really difficult. So some months we have higher expenses, some months we have lower expenses, but we try to figure out what that baseline is. And then I adjust it monthly for Jake and Gino. If I need to do more, if I'm doing a live event and I need to spend more there, or I'm pushing out more Facebook ads, I adjust that monthly and I say, hey, this month it's 10, this next month it's 15, but whatever it is, I know. And you have to plan. You have to plan for the future. You have to plan what you're spending towards. And, having a nice baseline, having a little extra money in the bank will always give you the confidence to go forward and take some risks and to say, I've got that little cash position in there.
I'm going to use what Brandon said actually with the property management, because the one area we struggle with is one of our core values is extreme ownership, thinking like an owner, et cetera. And they look at the accountant and they think, because their bonuses are actually based on the net cash profit every month. And so they don't necessarily have access to that because they have access to the portfolio. But then it's like, what are we actually netting on the property? So we want it to be aligned with what we, our goals are. And so we have different reports that we do. And we're actually working on another cash flow report with our accounting that's like a one-off that's outside of Appfolio. And it's just bringing this together because they'll look at it and they'll go in Appfolio and look in the expense register. Well, the expense register is not going to line up with the actual bank statement at the end of the month. So it's just finding ways to bridge that because they're never going to line up. But we want, our folks to know, look, this is based on cash. We're, as good as what our cash is. The accounting is great as a look back. And I think I'm gonna take that approach in the future because it's always been like this disconnect. Explain it to the PMs on exactly what we're trying to accomplish, and then we set up all these different KPIs and ways to track it. And I think we're really getting there. I think the last few weeks we've adjusted our KPIs on our pulse a little bit, and appreciate that explanation. That's cool. Yeah.
I mean, accounting is the history. The history is important, but it's not going to tell you that you have to pay this big property tax bill in 3 months. Mm-hmm. That's what your budget's going to tell you.
Yeah. What's the best way for folks to get a hold of you?
You can reach out to me on LinkedIn. I don't know I don't even know what my tagline is. I'm not prepared for that question, but you can reach out to me on LinkedIn. Just type in Brandon Hall.
It's called your handle, man.
Handle, whatever. That's bad.
You want to know about your handle. Come on.
Like LinkedIn. But anyway, you can reach out to me on LinkedIn. You can email us at contact@therealestatecpa.com, or you can check out our website, www.therealestatecpa.com. We've got podcasts, videos, blog articles. You can fill out web forms and all that stuff. So,
is the handle the real estate CPA?
My handle on LinkedIn is like Brandon Hall.
Okay.
CPA or something.
There we go.
We also have the real estate CPA for like the company, but.
Hey, Jake, thank God Brandon does accounting because he sucks at sales right
now. We got to get him a marketing advisor. I
know. I need to get Tom. You guys know Tom. Tom's the marketing guy. I need to get.
Just saying, bro.
G-Dad, what else you got?
It takes years to figure this stuff out, right? That's why everyone wants to go out and get 150 units on their first deal, and there's nothing wrong with that. I think a couple of things. First thing is it's really business. I mean, real estate is first and truemost business. We've been talking about KPIs and all that stuff. It's really tracking performance and really understanding what it's all about. It's debt and taxes. Right? I mean, it's debt and taxes. That's what Kiyosaki says, and he's a lot smarter than Jake and Gino. So I think that's truly important. I think onboarding a real estate person who's a CPA from the very beginning, let's start with that. Forget about Uncle Tony, because Uncle Tony's great. He might make pizzas, he might make Zeppelis, whatever that is. Leave him to that. You have to know real estate. And the thing is, you can't fire your uncle. That's the problem, because when he's doing a terrible job, how are you going to get rid of him? You see him for Thanksgiving. I mean, there's no way of getting rid of Uncle Tony. So go out and find a Brandon Hall out there. You know,
keep making the pizza.
Yeah, I'm telling you, you have to actually get out there and have a plan. And I think CPA is one of those team members that we don't really talk about as much, because they should be on the team, and you should be talking to them before you even go out and start looking at deals and have an idea of how it's really going to help you out. And then once you get a deal, like Brandon mentioned a couple of times with cost segregation, make sure you have somebody who's doing cost segregation when you're buying a property. Go out and reach out to them as you're putting that deal on the contract, because maybe they can help you out with values on land and values on what the building costs, and see what you're actually going to be saving. And maybe that can be some of your ammunition when talking to investors. So that's why you need to have these conversations in the beginning. We could have a 3-hour-long podcast on cost segregation and all that other stuff. So that's truly important. But reach out to Brandon, start networking with him. If you need an introduction, it's, hit me up at Gino, JakeandGino.com. I'll make you the introduction. I'm a little bit better at sales. I've been doing this for a few years. So sales is getting a little bit better for us.
It's getting deep in here now, man. Gino's saying he's good at sales. Now we know it's getting deep.
So I don't want to underscore it, though. It's truly important. I've had a great relationship with my tax provider for the last 20 years. And it's really also, Brandon, the other thing we forgot to mention is, don't be afraid to pick up and say, hey, Brandon, I've had another kid. I've had another child. I've had this go on. This big event happened in my life. Brandon needs to know what's happening in your life. He needs to know if you're changing your job, or if you're moving to another state, or if you're doing business in another state. They need to know the information. So you need to get in front of them. And I would say at least quarterly, get in touch with your CPA. Let him know what you're doing. I mean, we didn't talk about that. We should really stress that. It's about communication in every aspect of your business. Let them know what's going on. And I would go so far as to say we hit up our bookkeepers, I don't know, twice a week at least. So maybe a weekly little touch point, getting in there, letting him know what's going on. Maybe not with your CPA, but definitely with your bookkeeper. And don't be cheap like Jake and Gino. Outsource bookkeeping from day one. And it's an important thing for 35, 40, 50 bucks an hour.
I was an accountant. I was a lawyer, man. I did it all. Come on, man.
Chainsaw boy. But seriously, I mean, like I said, I can keep going on and throwing these little tidbits out there. But seriously, take control of your accounting, really.
Get over to iTunes too, and give us a thumbs up and give us a nice little review, because I don't know where else you're out there talking cash flow and accounting and making sense of it. So give some love to the Jake and Gino podcast, folks.
I've got one more.
Oh, he's still going. No one's going home. I got an L10 coming in here. We're still
just ask your CPA how they can help you too, right? When you're getting into the multifamily space, when you're getting into the syndication space, it's more than just compliance. It's more than tax returns. It's more than things. CPAs can bring a lot to the table. They might not be very good at telling you how they can bring value to the table. So ask them how you can help me scale this syndication business.
And go elsewhere for marketing.
What KPIs can you help me track?
That's great. Thanks, Brandon. We appreciate you being on, and everybody hit us up. Jake, see you next week, bro.
See you, gang. Thanks.
Take care, everybody.